Welcome to How to Sell Property and Not Pay Taxes. I am Jim Cunningham. I have got Conner Clemons here with me today. We're going to talk about 1031 exchanges and some other ways to not pay tax when you sell property. Conner, any thoughts on this?
Yeah, this is a great way to save money. I'm sure a lot of you have heard of 1031s before. They're quite the notorious tool. They've been under attack for years, and that's for good reason, because they do help people save a ton in taxes.
Very powerful tool. So let's get to it. So we have to give you, because I'm a lawyer, Conner's a lawyer. We're talking about a lot of stuff. We're going to run through this really fast, right? Your head might be spinning. This is not legal advice, okay? So don't listen to this and run out and start doing stuff. You're just going to get yourself probably into a whole world of hurt. So disclaimer, always seek out an expert advisor, whether it's a lawyer or a CPA or a realtor or a financial advisor. Always seek out somebody who's an expert in their particular field. We have a team of attorneys here. We are experts in everything tax planning, estate planning, setting up your living trust, protecting an inheritance from the future divorce of a son or a daughter. And I got to tell you, we see that, Conner, way too many times. People inherit money and then they're, the future ex-son-in-law or future ex-daughter-in-law gets a divorce. So we help lots and lots of people protect their legacies for their families. And, protecting a legacy from creditors is a big deal. And protecting it from predators with a P is also a big deal. And we view the government as a form of predator because I got to tell you, they view your assets as being partly owned by the government. So that's their point of view. And so we got to live in that world. So why are you here today? Why did you take time out of your busy day to come join us here today and learn about selling property without taxes? So it is because you likely own real estate or know someone who does and want to sell because of what I would say a low cap rate is. So a capitalization rate, the lower the capitalization rate, the worse. I see many clients coming in and Conner, you see this. We see people getting 2%, 1.5%, 2%, 2.5% on their California properties in terms of rents. So if you own $1 million property, you might be getting $25,000 a year income. We see that it's very common because it's very expensive to get anything done in California when it comes to maintenance. And also a lot of clients are just tired of difficult tenants and leaky faucets. And I don't know, Conner, when you meet with clients, is that what you hear? I mean, they're getting older later on in life. Yeah.
Yeah, definitely like the past, 10, 12 years, the real estate market, has been flat for a lot of people. People bought their homes in 2007, 2008. I was just talking to somebody who bought their first investment property in 2007, 2008, and all of their gain has been from just the rents they've received. So it is a small rate of return.
Yeah. And so also on the horizon, we have a potential, as we do this presentation, we are on the cusp of an election that's already started. People can vote in by mail. There's Prop 15. If you missed the proposition webinar that Conner did, I suggest you go back onto YouTube and take a look at that. Prop 15 is an attempt to reassess all property that is not residential property. So in some limited circumstances of agricultural property. But basically, if it's industrial, if it's commercial, if it's the barbershop, there is an effort afoot to effectively raise the taxes. And then COVID, we're in the middle of that COVID pandemic, and residential and commercial properties, if you're an owner of residential or an owner of commercial properties, you know what I'm talking about. You're either worried that you're not going to be collecting rent or you're not collecting all the rent that is due to you. And you can't really evict anyone. And, that's not going to get better for a long time. And even qualifying to buy a property, a residential rental property, banks many times will give you zero credit now for the rents that are due under the terms of the leases. So many people, we're getting lots of calls from people saying, hey, I'm leaving California, I'm retiring, I'm moving out of the state for, a variety of reasons. And so leaving California, if you keep your rentals in California, you have something called California source income, meaning you will continue to pay California tax on that, even though you're no longer a California resident. So what do many people do, Conner? They do a 1031 exchange out of California because the taxes are less. A lot of people do want to avoid or delaying paying capital gains on the sale of property. Not everyone, some of our clients don't really care, frankly, but I would say probably 95% of our clients really do want to avoid or delay paying taxes. And we're here to help you stay one step ahead. So we do have our first question here. You can put your questions in the Q&A. We'll just answer these as they come along. So when you inherit a property under Prop 13 tax laws, can you transfer that if you buy a new property? My mom recently passed, my brother was living there, and now it's got to be split. He wants to take the best tax break with him to his new purchase. And that was an anonymous attendee, but signed William. William, call Conner. There's a slide here where you can call him. You absolutely have to be taking a look at this. Generally, you don't take your Prop 13 taxes with you. But when it comes to people inheriting property from a parent and buying out a sibling, that is a topic for a whole other webinar, okay? Very important. And that is a very tricky, we are successful, our firm is successful in permitting the siblings to buy out another sibling and not get reassessed on Prop 13. But it is not a simple matter at all, a very complex matter. So
let me add something, Jim. Yeah. With those, the earlier, the better. Once, a mess has been made, properties have been distributed a certain way, you can't go back and change it. So if you are listening to this and you want to do the same thing, you want to inherit and you want to keep your property, the property's base year value, your parents' base year value, or take it to a new property, get started ahead of the game. It makes it a lot easier.
Yeah, because once you put the cream in the coffee, that's not coming out, right? And a lot of these tax strategies, what you're going to see is once you figuratively put that cream in the coffee, you preclude a lot of tax planning. So you can't take literally molecule by molecule the cream out of the coffee. So just bear in mind, there are some things that you do as a taxpayer that cannot be undone. And that's why it's very important to seek out an expert professional. So I'm going to start with what is capital gains tax. Now, I don't know we get a lot of CPAs, actually a lot of lawyers on these webinars. Forgive me for going back to the basics, but I want to make sure that everyone understands what a capital gains tax is. So a capital gains tax is a tax on the increase in value. So what we see here is we see this example. We have something called basis, and this ties in with our example that we'll be using for the rest of the presentation here today. $200,000 is the purchase price, and then the asset goes up to $400,000. So that is called gain. That is, you pay tax on that. It's subject to tax, capital gains tax. And then there is something called depreciation. So for those of you who have rental property, where there's a structure on the property or some type of improvement, not including farmland, some type of improvement, the federal government says that building's going to fall down in 30 years or that building's going to fall down in 40 years, depending on if it's residential or commercial. And what we're going to do is we're going to give you a tax benefit equal to 1/30th or 1/40th every year for that period of years. And so some people are under the mistaken belief that they can take depreciation or they can not take depreciation. That's forced on you with the government. So if you're not taking depreciation, you could be missing out on a tax benefit, and you might be paying more in taxes. So a capital gains tax is a tax on the increase in the value of the property. That is taxed at, do you see that number there? 37.1%. If you're in California, this is the maximum tax rate that is charged, okay? It is 20% federal, 13.3% state, and there is a proposal to raise that to 16.3%, okay? And then there's the federal net investment income tax of 3.8%. When you add all that together, it's 37.1%. Recapture of depreciation. So as you depreciate that property, when you go to sell the property, is taxed differently. It's taxed at a higher rate for federal purposes. Okay, so it's 5% higher, and it's somewhere between 37 and 42%. And what you need to really be mindful of is when people talk about, oh, capital gains taxes are only 20%, that's only part of the story. If you live in California or you have property located in California, that tax rate is much higher because California has no capital gains tax. It's all income in California. So we'll look at this example. You want to walk through this example, Conner?
Yeah, sure. I do want to tack on, I get people who are so confused why a lot of retirees move out of California. I think once they're actually paying that, 13.3% tax, they really feel it. So it makes sense. So the sale without a 1031. So here we go. We have our guy Doug. Doug is going to be our example person today. And he buys a duplex in 2010 for $200,000. That was his original basis. But just like Jim said, he's taken depreciation since 2010. So every year he takes a little bit of depreciation. So he takes a loss on his taxes, kind of like the president. And at the same time, his basis gets lowered. So he takes $65,400 in depreciation. You deduct that from the $200,000, you get that lower basis. He hasn't made any capital improvements, and now he wants to sell. So he receives an offer from a buyer for $400,000, and he gets his $400,000 check, but he has tax obligations to pay because he had taxable gain. And what are those tax consequences? All right, so let's go through it. So like I said, his basis was $200,000, and he deducted the $65,400 over those past 10 years on his taxes. So his basis has been reduced from $134,000 or to $134,600. Really, the way that you have to think about basis and depreciation deductions is it's just like Jim says, the government, the IRS, they're saying that, yeah, that building went down in value over those last 10 years. It's getting closer to that date where it collapses. But since he sold at such a gain, he obviously proved the IRS wrong. He showed that even though he was taking those deductions, the value of the property as a whole was going up. And so now he has to pay taxes. He has to pay recapture taxes on what it is that he depreciated. So he sells the property for $400,000. You can see the gain of $200,000. He has to pay 20% to the feds on that. And then he has to pay 25% to the feds on the $65,400 he depreciated. And like Jim said, California doesn't have a capital gains tax. It has an income tax. And Doug is going to pay 13.3%. So let's tally it all up. 20% of the $200,000 is $40,000 capital gains, 25% of his depreciation, $116,000. 13.3% of 265 is 35,000. And then he has his net investment tax, the Obamacare tax, $10,085. So he sells this property. He had that $200,000 gain, and government's going to want $101,000 from it. So you can see why somebody would want to avoid this, right?
Yeah, if they care. I think most people care. They wouldn't be here if they didn't care. So here's what I want you to pay attention to. I want you to pay attention to the effective rate at the very bottom. Yes, it is true that property is taxed at 20% capital gains on the federal level, but something to not forget is you've got all these other taxes, state taxes, recapture depreciation. So when people think, oh, I got $1 million gain, that's about $200,000 in tax, you can't think like that. You can't forget California tax. Your effective rate is over 38%. So what is a 1031 exchange? A 1031 exchange, that comes from the Internal Revenue Code. Okay, so Internal Revenue Code is the IRS statute book, and they say a 1031 exchange is a particular code section in the law. It's a law that was passed about 100 years ago, and it is called a like-kind exchange or a starker exchange. It's a swap of one investment property for another. So what I can do in our example here, Doug can do, Doug can sell this property and then buy another replacement property and defer the tax. So Doug can sell one property, buy another, and defer the tax. And so he doesn't pay that $100,000 to the government. He's able to reinvest that in real estate. And something to be mindful of is I know it's come under criticism lately in the political realm, but the United States has followed a cheap food and an affordable housing policy for 100 years. Food in the United States as a percentage of your income, I think it's the lowest in the world. Our food, we export corn to Mexico. Like, how is that even possible? It's because we can grow corn more efficiently than people in Mexico can grow corn. In part, farming subsidies, all these things you hear in the news. Well, real estate is also another favored industry by the United States government. And so they passed this so that people could buy and sell property without incurring a tax. And the idea is to create more housing for American citizens. So that's the background on it. Most swaps are taxable unless you follow the 1031 requirement. Like kind, what that means is it's real estate held for investment, basically. So an apartment building, a multifamily home, industrial. Can you go from multifamily to industrial? Yes. Can you go from commercial to multifamily? Yes. It's all considered like kind. So it's not like, oh, I have a duplex, I got to buy a duplex. As you'll see, that duplex, you can be traded up into a fourplex.
Yeah,
So
that like
yeah,
kind rule, Jim. For real estate, that's all the case. But we've seen people do 1031s on Ferraris, collectible cars, and
true.
so airplanes. So as long real estate is real estate, that's good. But those collectibles, they have to be like one another.
That's true. And aviation is another one that is favored by the U.S. government. So the government favors development of aviation. That's why until, I don't know, 20 years ago, the only country that made jets was the United States. And property is the bottom line. So some changes here, some terms, exchange or. Now, in preparing for this, exchange or came up as a misspelled word. That is the word from the Internal Revenue Code. So it's kind of an archaic usage of it's basically the person exchanging the property. So Doug, in this case, the seller. Relinquished property is the property that you're selling. The replacement property is the property that Doug's buying. There's buyers, there's sellers, and there is something called a qualified intermediary. We use the nation's largest qualified intermediary. They happen to be out of Roseville, California. They're very good. Something, a takeaway from this, a warning, there is no standard or regulation when it comes to qualified intermediaries. And I met with a client recently who said, wow, we had this 1031 and the qualified intermediary basically embezzled a bunch of money. And they were the last people to get their money out. And so a lot of other people lost a lot of money. So it's very important to pay attention. You don't want to go to Fred's qualified intermediary service or something like that. You want to go with a professional group, someone with a track record. So just something to understand.
Qualified intermediary before, haven't we?
What's that?
We've acted as a QI before. This
Yeah.
law firm.
Yeah, law firms can do that. So, but there's no regulation on it. So we have rules, two big rules that I want to talk about because these are important in the sense because they're two separate concepts. One involves a stopwatch and one doesn't. So Doug, the seller of the duplex, he has 45 days to identify a property. And you can see there's this stopwatch here and it starts and stops that 45 days. So you sell a property, you got 45 days, 5 days go by, you haven't found a replacement property. And on the 6th day, you find a replacement property. Well, on that day, the clock is stopped. So if that property falls out of escrow, you have 39 days left. And then you look for another you burn through another 7 days looking for another property. Now you have 32 days left. Meanwhile, you only have 180 days, which is 6 months, 180 days to finish the transaction, but you can identify and re-identify properties within that 180-day period. But it's something to be very mindful of. Many people run out of time. So one of the biggest errors we see is people running out of time. So very, very important. If you have run out of time this year and you're like, oh my goodness, I get this terrible capital gain, or you've run out of, you ran out of time on prior years, 2020 is a very unique year. You may be able to get some of that money back. And we'll talk about that in a little bit. Can a non-rental home be used for a 1031 exchange? We're going to answer that. Can a non-rental be used in a 1031 exchange? Short answer is no, but we will talk about that. So a delayed 1031 exchange. You want to talk about this, Conner?
Yeah. So before I really get into this, I've met with a lot of clients and talk about 1031s, and there's this preconceived notion that probably half of people have when they think of a 1031, they literally think of trading their current residence for another residence and not paying any tax. And they say, how can I possibly do that? What am I supposed to do? Go to some marketplace of people who want to trade residences? That is how a lot of people think of a 1031 exchange, probably because it has the word exchange in the rule. But that's not what we're talking about. We're talking about different type of exchanges, and the delayed 1031 is going to be our most popular. So we're going to go back to Doug, and we're going to change the facts of our first one. So now Doug, he has his $400,000 property that we talked about earlier, but he doesn't want to pay 6 figures of tax. He wants to take his money and he wants to reinvest it. So Doug finds a fourplex as his replacement property. He sells his duplex. He identifies this fourplex. Now, this fourplex, in order for a 1031 to work as intended, has to be worth at least the same or more than the relinquished property, the duplex he's giving away. And all the net sale proceeds that Doug is going to receive has to go towards this new property. So he's going to sell his $400,000 property. He has to reinvest all $400,000 in the new property for it to be taxable, or excuse me, tax-free. And so let's say that new property is $700,000. He sells his old property for $400,000, puts it towards this new property. He can take a loan, he can pay cash for the rest. But that $200,000 gain we talked about earlier, he's not going to have to pay anything on it because he's reinvesting his property, reinvesting his money in this new property. And that is a delayed 1031 exchange. Jim, what do you have to add?
Well, that's exactly what we're talking about here. So he's gone from his duplex here to the fourplex, and he's gone from a $400,000 property to a $700,000 property, and then gone to a bank for the difference. Now, what if he decides to take some of that money out? What if he buys a $300,000 place? Or let's say he does buy the $700,000 property, but he borrows $400,000. Okay, so the term boot, where does that come from? By the way, that is one boot from a $3,000 pair of boots. I found the most expensive pair of boots I could find in preparing for this. So here's where boot comes from. Imagine the Old West, and two parties determined that one horse was worth more than another. The person that received the more valuable horse, the better horse, right, had to pay something to the other one. And the examples were, these are colonial examples, money, tobacco, sugar, to even the score. And the additional item went into the recipient's boot. That is where the term boot comes from. So in this case, if you trade the duplex for the fourplex and walk away with $100,000 in your boot, you're going to pay tax on that $100,000 that goes into your boot. And so that's what boot is. If you have debt on the property, little warning, it does complicate things, okay? It makes it very complex, and this is why you really do need to work with a qualified realtor, qualified intermediary, a qualified intermediary, right? A quality qualified intermediary, your lawyer, your CPA. These people have to work together before you do the transaction. And this is really important because Conner mentioned this at the beginning. Sometimes people put cream in the coffee and it can't come out. If you do this stuff out of sequence, you may find yourself scrambling to avoid a pretty hefty tax bill.
There is no forgiveness here. Can you go back one more second? I want to talk about that depreciation that I glossed over. So how does depreciation work? So we've talked about depreciation. Doug was taking depreciation on that first $200,000 property he had. So now he exchanges, okay? He exchanges, he's in the new $700,000 property, okay? He took a $300,000 loan. He sold the last one for $400,000 plus a $300,000 loan. Well, now he's going to continue depreciating that original $161,000 left over from the first house. He still takes that depreciation, but now he's going to depreciate the $300,000 basis of the loan on the new property. So that's the crazy thing about a 1031 is he's depreciating on money that he's borrowed. So this is really a lucrative thing, even if you're not totally dying to own more real estate, if you're not loving the feeling of having tenants. This is something that real estate offers, the ability to depreciate money that you borrowed. Jim, I do like this picture here, by the way. This is very,
very LA. So, you know, another part of this, something to think about is as we age, you'll get there one day, Conner, as we age, and you hit 72, you have minimum distributions from your IRA, and it runs about almost 4%. If you have a few $1 million in your IRA, that can be $100,000 a year, right? And so we have many clients who have $100,000 a year minimum required distribution. We see a lot of clients in their 70s starting to do 1031 exchanges for two reasons. Number one, they're out of depreciation. They still have income, but they need more depreciation because they see their tax bill going up. When your tax bill goes up, your Medicare Part B goes up. And if you look at the chart, it can go up quite a bit where you're paying a lot more out of pocket for your Medicare Part B. And so what people are able to do is the Dougs of the world are able to do a 1031 exchange into new property, take on some debt. What a great time to take on debt. I mean, what is it, like 3% or something right now, less than 3? Great time to take on debt. And what you're able to do is you're able to get more depreciation. And as you'll see, it gets even better when a person passes away. And in many times it's a spouse that passes away. And I don't mean that in terms of like, it's getting better because your husband or your wife is dying, but you're going to see there's a tax benefit associated with a person passing away. So let's talk about, so we've talked about a deferred 1031 exchange. Let's talk about a reverse 1031 exchange. Okay, anonymous attendee asks, can one do a 1031 exchange on a property one has inherited and avoid estate tax? Different issue. There are a lot of ways to avoid estate tax, but that's something, if that sounds like there's a lot in that question, so just give Conner a call. Call 866-988-3956. Set up a 15-minute call with Conner, and hopefully he'll be able to answer your question or see if we can help you out with that. So what's a reverse 1031 exchange? So a deferred 1031 exchange is when Doug sells a property, then buys another property. A reverse 1031 exchange is where Doug buys a property first and then sells his property. So what happens is Doug identifies the fourplex before selling his duplex. A third-party entity, not Doug, an entity, an LLC typically, purchases the fourplex. Doug then sells his duplex and then buys the fourplex. So it's very important to understand that the Internal Revenue Code does not permit the exchanger, Doug, to own both properties at the same time, right? So there's a sequencing, and this 180-day time limitation does apply. So if you say, gee, Jim, I don't know that I want to commit to that 4,580-day time period because I haven't yet found a property and I'd like to wait, you can do that. But it does require a bigger capital outlay, so it's a little more complicated in terms of the deal structure. And we do have another question. Okay, I already answered that. That's a reverse 1031 exchange. Not super common, but we do see them. A 1031 into a triple net property. Okay, so what is a triple net property? I picked Chick-fil-A because, I don't know, I like Chick-fil-A. They have good the good nuggets without any covering. I'm trying to lose my COVID extra LBs. So Chick-fil-A, great company, super profitable. I think these stores, they're closed one day a week, but their profits are like 3x the next competitor, chain competitor. So really solid corporate tenant. Here's what a triple net property is. Doug buys the property, meaning the land, and the tenant, and in this case, Chick-fil-A, is responsible for everything: taxes, maintenance, insurance, the whole deal. It's a 15-year term. Doug gets a check once a month. This particular property is $4 million. It has what's called a capitalization rate of 4.5%, which means Doug gets $45,000 per million, so about $180,000 in income from this property from a $4 million investment. The pros is that it's marketable. These things are regularly traded, so they're like a bond almost, right? So if you say, gee, I've got this $4 million triple net property, I want to sell it, there are buyers for those. They're looking all the time. So there's a big trade in triple net properties. It is a passive investment, meaning you don't have to do anything. Your check arrives every month. The cons are you got to come up with $4 million, right? And some people, they're like, I don't know if I want to put $4 million in a Chick-fil-A in Kentucky or wherever it is. There's some economic risks, right? Risk of economic vacancy. What if Chick-fil-A doesn't pay their rent? Or what if the tenant doesn't pay their rent? That's called economically vacant. Economic vacancy is when the tenant is in the building, but they're not paying rent. So that's not vacant, but it's economically vacant. So there is some risk associated with that. And then, what happens when the 15-year term is up? It's a question mark. So these are and if it's in California, by the way, it's a lower capitalization rate. It's going to be less than 4.5%. The 1031 into a professionally managed portfolio. So let's say Doug says, I don't have $4 million to put in a triple net property. I have a small amount, and I really don't want to deal with, You saw the picture of that fourplex, Connor, right? Do you think they're going to have plumbing problems? Do you think someone might not pay their rent? Do
Yeah.
you think it might need a roof? It might, a lot of people come in. My parents are in their 70s and they're just like, we're so tired of dealing with tenants and all that stuff. They hire a property manager. They're just dealing with it. That's one way to deal with it, right? So what happens is the professionally managed portfolio, Doug sells his property, and instead of buying a replacement fourplex, he invests in a certain type of trust. It is like an untraded real estate investment trust. And it has about a capitalization rate of about the same, about 4.5%. So it's about 45,000 of income per million invested. Pros, it's a passive investment. Like the triple net, it's a passive investment. The other thing I really like about it is you have an allocation of risk, meaning look at all these tenants: Walgreens, Tractor Supply, Starbucks, kidney care centers. So you might have one fund of $50 million that owns 10 properties, right? And so you might say, oh, I'll put 100,000 in that one and 100,000 in that one and 100,000 in that one and 100. So you got 40 properties. So it really does spread your risk out. And that is what we're seeing with clients is some of our clients just frankly are getting their rent's not getting paid. And there's not a lot you can do now. You can't evict the tenants. So what are you going to do? The cons, this is not marketable. Your money is essentially locked up for about 7 years. So that's the con. But for a lot of people, they go, I don't really care. I mean, it's not like I'm going to sell the property and pay the tax. That's not going to happen. What are your alternatives? And many times if people have leftover money that they can't place, so if Doug found a $300,000 property, but he had this $100,000 boot left over, he could put that into a professionally managed portfolio. So you can do both. Patty asks, we have multiple residential rentals and would like to do one big 1031 exchange out of all of our properties simultaneously and turn them into one big commercial rental. Would the logistics be completely impossible, or is this doable? Patty, I think that is probably a reverse 1031 exchange where you would identify the property, buy the property, then put up your properties for sale. That's something, I happen to be a licensed real estate broker. And so we don't do like normal transactions. We tend to do transactions like this where people are coming together and we're coordinating a lot of transactions. So I'd be happy to talk to you about that. Connor would be happy to talk to you about that. We work with tons and tons of realtors. But I figured it was good for me to be educated in that process since our clients are relying on us for solid legal advice. But I think it's totally doable, Patty. And it's nice.
Yeah,
The issue with having them in one big 1031, you got to think of risk, right? What if your tenant doesn't pay? So that's the only concern I would have with that transaction.
It's more common to do the opposite, Patty, to go from one building to multiple buildings, but your way is also something people do. Definitely give us a call. We help clients all the time orchestrate their 1031 from beginning to end, realtors, QIs, all of it.
So let's look at Doug's example. Doug's got a $400,000 duplex and his rents are $1,500 a month. His taxes, insurance, maintenance are $500 a month, right? Kind of a high maintenance building. So he's making a 3% return. His annual income is $12,000. Doug sells the property, does a 1031 exchange into a professionally managed portfolio. His income increases 50%. Okay. He has no tenant hassles, no more leaky faucets. He's making a 4.5% return. So his income goes up. He also gets the benefit of cost segregation. Well, I don't think we're going to talk about that in this one, but when your properties are in a professionally managed portfolio, they do what is normally a pretty cost prohibitive planning strategy where they accelerate the depreciation. Instead of 30 or 40 years, it's shrunk down to about 8 years. So a lot of the income that you're getting ends up being tax-free. So that 18,000 might effectively be a much higher number for Doug, depending on his tax bracket. You want to talk about personal property, Connor?
Yeah, people always ask, can you exchange personal property in a 1031? I talked about that example of the Ferrari earlier, or a boat or a plane. If you use your property in some type of trade or business, then you can exchange personal property. So it could be something like what I just mentioned there in a trade or business, and you could be in the business of collecting cars, or the business of renting out your airplane, Or if you're buying a law firm, or if you're buying, if you're the person who just trades office equipment, you can do 1031s there. But it's difficult to do it on small things that aren't going to be in that business. But as long as you use it for a business purpose, it's possible.
I would say aircraft are probably the most common traded item. There are a lot of tax benefits. Again, the United States government is heavily favors aircraft R&D. And so that's a tax advantaged that's a whole nother universe. That's a whole topic for another webinar. Vacation home. You want to talk, Connor, you talk about the vacation home in 1031.
Yeah, and this is another really common question we have. We always have people that want to change their vacation homes. They want to do an exchange on a vacation home. So unfortunately, if it's a true vacation home, like a second home, you're not going to be able to do this. It has to be a vacation home that you utilize usually as a short-term rental, because the rule is if you are trading a vacation home, it has to be mixed use. You can only occupy that home for 14 days or fewer per year, or no more than 10% of the time or the occupied time if you occupy it and rent it out, whatever number is less. So really, you can do a short-term rental like on Airbnb. You can stay there for 14 days a year, and then you can exchange it and have the 1031 done correctly. And you have to do this for 2 years. You have to show that you've done this for 2 years. Now, when you exchange it with the replacement property, you have to do the same thing. You have to rent it out for 2 years. If you do that for 2 years, then you can potentially turn it into a vacation home. But for those 2 years, you have to make sure that you only stay in that property for 14 days or less.
And then the Internal Revenue Code Section 121 exemption. This is on your residence. So this answers the question, how do you sell real estate without paying taxes? If it's your home and you're a single filer, it's $250,000 in exempted gain that's excluded. This does not count, or this does not apply to recapture of depreciation. So very important to understand. So if you've depreciated a property and then later moved into it and then sell it, you might be subject to recapture of depreciation. Married filers can exclude $500,000, and this is important, even if it's a separate property asset. So if the wife has a separate property asset, a residence that's increased, and she's a joint filer, she can claim that $500,000 exemption. Very important. And you have to occupy it for 2 of the last 5 years. And literally, they count the days, right? Literally the days. So let's look at an example. This was a $75,000 home in West LA. This is actually from the MLS. I pulled this off preparing for this. This house is listed for $2.6 million, folks. This is not fake. That house right there, $2.6 million, acquired in 1975 for $75,000. Prop 13. Prop 13, guys. If this was my parents' house, I would really try really hard to hold on to it, because that thing's going to rent for a lot of money, right? And we're going to be paying property taxes, probably $2,000 a year. Whoever buys this is going to be paying about $32,000 a year, 32 in LA County in taxes, 30, 32, something like that. So if Doug sells his West LA home and moves to Las Vegas, he has a gain of $2 million. So you see the 75,000 basis, and he's obviously done nothing to that home since 1975. Maybe he's mowed the lawn. He can exempt. He's a married. He's a joint filer. He can exempt $500,000 in gain, but that leaves $2 million in gain. That's $742,000 in taxes. You know, when I did the math on this, Connor, I was like, you got to be kidding. $742,000 in taxes. That is a lot of money to pay. Okay. I mean, I don't care how rich you are. That's a big check to write. So Doug can move to Vegas and he can rent out the West LA home. Let's say he goes, you know what? I'm going to rent this thing out for, I don't know, what's that rent for? I don't know, 10 grand a month, 9 grand a month, 8 grand. I'm just going to rent it out. I'm going to convert that to a rental. Once it's a rental, he can then do a 1031 exchange into a property in Vegas. Now he can later decide, after renting that property out and having it season, right, and be a rental, he can choose later to have the tenant move out and move into that property. And he's now converted a rental to personal use. That is not a taxable event. Here's the problem you have to watch out for, though. There's something called a step transaction where the IRS says, hey, if they aggregate all the transactions, sometimes they push them all together and they'll say, nah, that's not really a 1031 exchange. You know, you can't rent it out for a day, do a 1031 exchange and rent it out in Vegas for a day, then move into it. That's not going to work. But that's something that Conner and I can go over with you. Something that's also really important to understand, and I didn't put this slide in because it's a little kind of, you can just kind of go on and on with this stuff. If you own property in a partnership or an LLC, there is something called dropping and swapping the property. So if Conner and I own a property that's gone from 75,000 to 2.6 million, and we want to do a 1031 exchange, but we want to do our own 1031 exchange and we don't want to be partners anymore. What some people do is they will distribute the property to the individual and then do the 1031 exchange. That works for federal purposes, but for state purposes, they very well may disallow that transaction unless there's been sufficient time post distribution from the partnership, and you typically do a co-tenancy agreement. Then later, in later tax years, you effectuate a 1031 exchange. So you can't drop and swap in California. They really look unfavorably on that. And if you lose your California tax deferral, that's almost half of the tax bill. So it's a big deal. All right, let's combine. Oh, this is good. You want to talk about this one, combining 121 and 1031? I like this.
Yeah, sure. So we have the example where Doug buys the home and lives in it for 2 years, and then he rents it out for the other 3. So when Doug sells it, he's going to get either his $250,000 or $500,000 exemption, depending on if he's married. So, I mean, he's not going to have that much gain because he's only owned it for 5 years. He gets to knock off any of his gain with that $250,000 or $500,000 exemption. Now, he will have to pay the recapture for the 3 years that he rented it out. But it's going to really minimize his gain because he lived in it for 2 years. Now, we talk about this bonus right here, which is some of our clients, they do the similar thing. Doug can sell this property to himself. He can utilize an LLC, whatever. And that way, he's going to get a new step-up basis. So if you buy a property that you know you're going to want to hold on to for a while, you can live in it for 2 years and then rent it out. And then into the 5th year, you can sell it to yourself and you can get that new basis. If you want more information on that, definitely make an appointment. But that's a good way to minimize capital gains. Now, I do want to make a point that this 2 out of 5 year rule for the 121 exclusion, you don't have to live in it continuously for 2 years. You just have to live in the home for 2 out of the last 5 years. So Doug can also do it in reverse. He can live in a rental for 2 years to claim the 121, whatever it is he wants to do. So if Doug acquires the property in 1031 exchange, he can rent it out for 3 years, live in it for 2 years. He can get that exemption, plus he can do the 1031. And if you have a mixed use property where you live in one of your duplexes or your fourplex properties, and you do the 1031, you can also qualify. But that's a really detailed one. You have to call us for it.
Yeah. And you know, a lot of people do that. They'll move into a rental and then sell that property and then move into another rental and sell that one and move into another. But you can only do that once every 5 years. So it's very important.
I mean, we see people with these 1031s that just do them their entire life. You know, you buy the condo when you're young, and then you want a little bit more rent, you 1031 into the single family residence, you 1031 into a beach town. And the whole goal is what you see here. Hold these properties until one day you pass away. Because what happens when you pass away, Jim?
You get an adjusted cost basis, up or down, but generally up. And so what happens is husband and wife own a bunch of property. They paid, $500,000 for all these properties that are now worth $5 million. If they sold those properties, they'd paid over $1 million in tax. Husband dies, the wife can sell all those properties and not pay tax. And this applies to all your assets with some exceptions, but applies to all your assets. When Steve Jobs passed away, his widow was able to sell $450 million in stock and avoid about $150 million in capital gains tax. There is no limit on this. It's very important to understand. You could have a $150 million real estate portfolio and one spouse die, and the survivor can sell all those assets free of capital gains tax, assuming they're sold at the value they were, the date of death value. Here's where this doesn't work. Does not work with the B trust. If you have had a spouse pass away and you went to the lawyer and you set up this B trust or a bypass trust or a credit shelter trust or a family trust or whatever, this very well may not apply. And so last year, our firm helped our clients about in 50 separate cases go to court to terminate a B trust. Why do we terminate a B trust? Because there's a bunch of baked in gain inside that trust. So if you've lost a spouse and you think you might have a B trust, call Conner, and in just a couple of minutes, he can tell you if you think you have a B trust or not.
That being said, Jim, too, like I meet with clients probably once or twice a week who have a B trust. People who haven't reviewed their estate plan for the past 10 years or more so than that. And B trusts are generally going to be outdated because of portability.
Yep.
You can combine your exemption with a deceased spouse with an estate tax return. You don't have to put your property into two trusts and sacrifice capital gains tax.
Yeah, and if both spouses are still alive, you can clean that up with a restatement of trust, which is where you take the old trust and put in a new one out with the old and with the new. But if someone's passed away, you very well may have to go to court to terminate that. Also, the generation skipping trust, if you have one of those, you probably know it. You do not get an adjusted cost basis on that. Now, it does work with a partnership or an LLC, but you have to do everything correctly. And we had one case last year where, unfortunately, the CPA made an error and it cost the family a couple million in taxes. And again, many people do 1031 exchanges later in life. This is not really something that people do when they're younger. Tends to be older because their basis gets really, really low in proportion to market value. So sometimes they want to step up into a more expensive property, frankly, and get more depreciation to pay less tax.
And let me spell that out really quick. So I'm going to go back to my example with Doug. He bought that original house for $200,000. Okay, he exchanges it for the $400,000 property. Even though he bought this new $400,000 property, the reason why this is a delay of paying taxes is his basis still stays $200,000 minus the depreciation. So let's say he does another 1031, his basis will still stay $200,000. Now, if he ever sells because he just wants cash, he's tired of managing real estate, he will pay on all that gain going back to the original $200,000 house. That's what we're talking about here.
All the cows come home. Okay, so call Conner, super easy, no obligation phone call. We make it easy. Call that number 866-988-3956. If you're outside of the US, 626-585-6970. We actually have a lot of clients who are outside of the US, so they come to these webinars and then they say, I'm stationed in Germany, I need help, right? Or I'm in Dubai, I need help. So let's get off of 1031 exchanges and talk about other stuff. There is excess and surplus lines. Excess and surplus lines is insurance coverage, okay? It insures things that standard carriers don't cover or won't cover. Every Fortune 500 company has excess and surplus lines. What am I talking about? Do you remember United Airlines and Dr. On? Dr. On was the guy who was on the flight, would not get off the plane, and they dragged him off the plane, and everyone had their phone and they were recording it. Well, no one booked a ticket on United Airlines the following week. They actually lost money. They had a policy, an excess and surplus lines policy, that gave them an insurance benefit because of that. So that's kind of strange insurance that this is not really a normal type of insurance. And so what Doug could do if he says, I don't want to do a 1031 exchange, or if he said, oh my goodness, it took me 46 days to identify a property, or that property closed on the 181st day. So he didn't get everything done in time, and he's got this taxable gain, and he's starting to freak out. He's like, I got $100,000 tax bill I'm going to pay. What can he do? Well, he could do an excess and surplus line premium for $26,000, $265,000. He pays 10%, finances $238,000 through the insurance carrier, and defers that tax bill, because that $26,000 is also deductible, defers that tax bill, that $101,000 tax bill, at least 5 years, okay? There's some other things he can do tax-wise to mitigate or eliminate that tax bill, but this is a strategy that is commonly employed to defer taxes, and we're going to see why 2020 is a better year than any other year in my practice to do excess and surplus lines. This is just a tool, by the way. Here's the deal. What if Doug says, hey, this is great. I'm really worried. If I sell that property and there's a problem with mold, or there's a problem with whatever, and what you're insuring is things that are not normally insured. Like if the deal falls apart and the real estate market crashes, he doesn't want to have to give the property back when it's not worth that much, and give the money back and get the property back. So Doug takes out an excess and surplus policy for $1 million. He writes a check for $100,000. His entire premium of $1 million is deducted in 2020. He then files for a refund for 2019, 18, 17, 16, and 15. This is totally legitimate. This is the CARES Act. This is called a loss carry back. There's a loss carry forward, but for 2020, there is a loss carry back. So if you paid a lot of taxes between 2015 and 2019, there is this incredible opportunity in 2020 only, and you have to do it this year. There's this incredible opportunity to get refunds from prior years, right? If you show a loss this year, and there's a way to show this loss. And if this just like went over your head, like, oh my gosh, what are you talking about? If you're making more than 500 grand a year, and you've made more than 500 grand a year for the last 4 or 5 years, absolutely, I highly recommend you call Conner, call me, set up a time to speak with us. Certainly, if you're making over $1 million a year, this is absolutely a fantastic strategy. If you want to get out of properties and not pay capital gains tax and maybe reinvest and get more basis, great opportunity. You can couple this with cost segregation. For those of you who don't know what that is, I mentioned it's a way of accelerating your depreciation. There are a lot of ways that you can invest your money. You can take advantage of certain provisions in the tax code to minimize taxes now and going forward. And so many of our clients have done this, and it's a great opportunity. But it's like any other tool. It's either going to work or it's not going to work. It's going to work for you or not. So installment sales is another alternative to a 1031. What's an installment sale? Doug sells the duplex. He's got a $265,000 gain on a $400,000 sale, $100,000 in taxes. What Doug really wants is an income stream, right? Because you can't, if he's limited to $12,000 a year and he says, I really need like 40 a year, 40,000 a year. Doug sells the property, and instead of getting the money directly, the money goes to essentially an intermediary, which is a third party. That person holds the money and distributes that money, doles that money out to Doug over a 10-year period in our example. So it's 40,000 a year plus interest. This is different than taking a note back from a buyer, because there's no risk of default. When you give someone a property and take back a note, you are really risking your income stream on that borrower's ability to pay. And in this case, the borrower went to a bank and got the money and gave it to a third party, and that money's given to you over time. There are complex tax rules involved, but understand this is an alternative to a traditional 1031. Now, what you could also do, Doug could turn around and still buy the duplex. Now he's going to have a much higher basis. So a lot of ways to save on taxes. Solar credits, we are having, we're putting together a webinar that we're going to do next month on post-election webinar on all the different tax credits that are available. There are all the different ways to pay less in income tax. So the solar credits, what they are is if you invest $100,000, you get a $26,000 federal credit, meaning a credit is different than a deduction. A credit is the government basically gives you money, right? That's what a tax credit is. So if you put in 100,000, you're going to get 26 back, and then you essentially own a solar facility and you're collecting rents off of that from the tenant. Now, these are typically coupled with charitable. I know the Archdiocese of San Francisco did one deal that I saw recently. They are a charity, so they have no reason to the tax credit. They don't pay taxes. It's of no benefit to them. And so what they do is they hire or they seek out investors to put solar panels on their buildings, and then they pay for the electricity, and you're basically setting up your own little electric company. So that's another thing that's out there. Many of our clients look at solar credits, but the federal tax credit's very powerful. Unfortunately, there are no more state tax credits available. So Doug, on this case, he sells his duplex. He takes $400,000, puts it into a solar project. He gets $104,000 federal tax credit, meaning the federal government gives him money, right? and he's got an income stream from the project and actually pays no tax at all on this one because his tax bill would have been $101,000. So he pays no tax at all, and he's better off. And so this could be better for Doug than a 1031. So my point is, it's not always a 1031 strategy that you're going to be looking at. There are other strategies out there. So very, very important. And then free call with Conner there. Give him a call, no obligation. Call us. We make it super easy, 866-988-3956 or the 626-585-6970. We will open it up for questions. Any thoughts, Conner?
No, I mean, if you're not looking at ways to save in taxation, you're not trying, right? That's what they say.
Yeah.
So, you know, there are lots of different ways to get these things going. And there are always new ways coming up. You know, we talk about it. Why is the Internal Revenue Code there? It is to raise revenue and it's to encourage certain behavior. So if you're wondering, why is this loophole here? We're talking about 1031s. You know, government has an interest of people exchanging properties, people continuing to invest, properties changing hands. You can see the last one too, the solar panels. Why is that there? They want people to invest in alternative forms of energy. So really take part in this.
Yeah. And, you know, I want to say something. I know we have an election coming up, and there's a lot of people are worried about, oh, well, if this person wins, then, you know, and then if that person wins. Something to be mindful of is I saw a webinar and by a very well-respected financial institution. And what they did is they put up the economic, this is just purely economic terms, the economic performance of the country, whether it's Republican or Democrat. Guess what? It's the same. So don't, you know, if you have a lot of anxiety about the upcoming election when it comes to economic things, it's going to be all right. I mean, this is America. This is the greatest country in the history of mankind. And I think we're going to be fine. So Ruth asked a question. Do you guys have any thoughts on deferred sales trust or opportunity zone investments? Yeah. Deferred sales trust is something different than what we were talking about. There's a question mark on those, whether that's a tax shelter or not, but great question. And opportunity zone, the next slide I was going to do was opportunity zone, but I figured, you know what, this is way too much. I think our brains are full. But Ruth, thank you so much for that. But opportunity zones are basically areas where the government says, hey, if you invest here, you can defer capital gains tax. And then, so Doug could sell his property and invest in an opportunity zone. And I will tell you, there are opportunity zones in Brentwood, in Southern California, not the Northern California Brentwood, but there are opportunity zones, I think in Culver City. These are places that you go, that's an opportunity zone. Are you kidding me? So I think Century City, there's even an opportunity zone.
Basically, right? All downtown LA's opportunities.
Well, and downtown, but my point is, these are alternatives to 1031. So Doug could take that 400,000 and he could invest that into an opportunity zone and defer the tax. And after 10 years, any additional gain he receives on that investment is federally tax-free. So that's a really good, Ruth, thanks for bringing that up. And we'll give it a couple more seconds. We go check out our website. We've got upcoming webinars, and I'm working on one, which is all things. We're going to do this mega webinar on all the tax planning strategies, including opportunity zones that are available to people. So something to really pay attention to. When it comes to tax planning, by the way, it's going to be a very busy year. So certainly, if you want to do tax planning for 2020, folks, and here's a little bit of sound advice, don't wait till 2021. Don't wait till February or April 14th when you go to your accountant's office with a bunch of receipts. You got to do this in 2020. I mean, this is true for any year. For this particular year, if you're going to do any kind of income tax planning, do not wait. What I'm hearing from accountants and attorneys and CPAs, but most importantly, the valuation people, okay? These are the appraisers. These are the business valuation experts. There is starting to be a line of people forming at the door, and a lot of disciplines have to touch. You know, if you're going to do a tax plan, many disciplines have to touch that plan and work on that plan. And what's happening is people are really having a lot of anxiety about next year, what might or might not happen. And so there's a lot of activity happening. And so I would just counsel you not to wait. So don't just say, oh, I'm going to wait till December 28th, and then I'm going to look at this stuff. Nah, it's too long. So you need to hop on it now.
And really quick, if you go to our YouTube page, Cunningham Legal's YouTube, you can see my proposition video from last Thursday. I cover all 13 of California's propositions. Election day is 2 weeks away, and there are a lot of different propositions that have all different types of things. So go check out that YouTube video.
All right, now let's go watch a World Series. All right, guys, have a great day. It was great time today with everyone. So I look forward to doing these in the future with you guys. So anyway, have a great day.
Thank you.